Thank you for staying with us. Investors have continued to backpedal on the stock market, especially in the banking sector, on the back of the proposed recapitalization of banks announced late last month by the Central Bank of Nigeria. The risk-off sentiment resulted in the loss of 633 billion naira as investors took profits from the banks. Consequently, the market capitalization of all listed equities fell to 57.87 trillion naira at the close of the holiday shortened week from 58.49 trillion naira in the previous week, representing a 1.1% decrease. Further analysis shows that activity level was also impacted by the shortened trading week as the total trading volume and value weakened by 69.2% week-on-week and 50.5% week-on-week to about 31.58 billion naira and 734.4 million units. And to talk about this in detail, I'm joined by a chartered accountant and financial analyst, Akin Fatunke. Good evening. Glad to have you join me.
Thank you very much, Adebola. Good evening to Nigerians.
All right. Now, let's talk about the factors you think are key in contributing to the decline in the stock market's performance due to Nigerian banks' recapitalization.
Very simple. The stock market is a risk hedging kind of market. And, management of change becomes an issue. Cautious optimism. Naturally, there will be the risk of sentiment by investors. Now, this has just come to us. Are you sure we're not going to be having dilution? Are you sure it is going to be real? In 2005, 2015, when Soludo came with around about the same process, what is really going to happen? Are we going to be swallowed? And who is going to be who? That will be looking at these banks. Are you sure my money is not going to, just go like smoke? Also, admittedly, we must recognize that the week that had just come back has been shortened. It's been, shortened trading week. So we may not be able to really find out in reality de facto whether if we didn't have the holidays and extended holidays, the value will not have shrunk by the 69.2%. Anyway, there is a sour mood in the market, cautious optimism. So we still expect this sour mood will continue for about 1 week or thereafter, and then we begin to see rays of sun. I begin to see situations where the first-tier banks who constitute over 70% of the assets in that space and revenue in that space already making arrangements for extraordinary general meetings. FBN Holding has done, GT Holding is doing, UBA is also doing. And investors are looking and are just watching and say, yes. With this kind of confidence, I expect all things being
just to chip in there, Mr. Fatunke, talking about investors, what signal does this send to them? And then what strategies can investors employ to mitigate losses such as these when we have a market turbulence?
Again, I dare say that the losses might not be real, maybe latent. Again, like I said, by the time confidence begins to swell in, we begin to see more moves in the macroeconomic sector of government. Investors are much more likely to have a bit more of confidence and become a bit more bullish. But in the meantime, I know some of the first-tier banks are already talking about ordinary share issue, rights issue, private placements, talking about merger and acquisition. And it is this corporate move that the matadors will begin to look at and say, I think we can sift the boys from the men. Then you can then go for preference shares. Don't also forget that the market is bouncing from the monetary side. A good, more than good news coming from Dr. Cardoso and his group, making sure that at the end of the day, FX and foreign direct investment is coming in, and then the rating agencies are priming. We need to wait to see some of the things that the rating agencies are going to be making.
Mr. Fatunke, I wish we had more time. Apologies for butting in. I wish we had more time, Mr. Fatunke, but thank you so much for your expertise on the news. Chartered accountant and financial analyst, Akin Fatunke. Thank you once again.
Thank you very much. The sky is blue for Nigeria, and I bask in that. Thank you.